Hi there. In the first part on reading 32 of the CFA curriculum that deals with long-term liabilities, we'll study the accounting for bonds and long-term debt. So we'll start with an overview of the bond terminology, the effective interest rate method for accounting, the accounting for issuance costs, fair value reporting, how the effective interest rate method impacts the financial statements, the derecognition of debt at maturity or otherwise, and finally debt governance and disclosures. As we've studied earlier, companies need capital to expand, to purchase assets, etc. And that capital can come in two sources, broadly speaking, equity and debt. Equity holders are the owners of the business, and debt holders have fixed repayment terms, that is, they'll get a fixed interest and repayment. So debt is issued by writing contracts called bonds, wherein the company receives an upfront amount and promises to make fixed repayments. So a bond is a contract between a borrower and a lender that obligates the bond issuer to make periodic interest payments to the bondholder over the term of the bond and repay the principal, also known as the face value or par value, at maturity. The borrower in turn receives the price of the bond as a cash inflow at issuance. So we receive some cash inflow and then we make promised repayments up till maturity. There are three terms that decide the cash flows from a bond. The time to maturity, let's assume it's a number of 3 years. The par value, let's assume that's $100. And the coupon payment, let's say it's a 5% annual coupon, such that 5% of the par value is paid every year as coupon. So the cash flows from this bond will be depicted as $5 at the end of year 1, another $5 at the end of year 2, and $5 plus the par value at maturity, so $105 at the end of year 3. So these three terms determine the cash flows from a bond, and like every asset, the value of these cash flows to the investor or the bondholder would be the present value of these expected cash flows. So the investor will discount these cash flows back to calculate the present value or the price of the bond. This discount rate, please note, will depend on the current market rates of interest. So the discount rate will often be different from the coupon rate and will help us calculate the price of the bond as the present value of the expected cash flows. So the first cash flow will be discounted back by 1 plus the rate of interest to the power 1. Second cash flow would be discounted back 2 years. And the third cash flow will be discounted back 3 years, as we've studied earlier. Please note, if the price of the bond is given or is available from the secondary market, then we can use this equation to calculate the discount rate that will make the present value of the cash flows of the bond equal to the price of the bond. And that discount rate is called the yield to maturity of the bond. The yield to maturity is a reflection of the current market rates of interest. And as we'll see in detail in the review on fixed income securities, if the yield is greater than the coupon rate, so we are discounting by a higher rate, then the price will be lesser than the par value and it will be called a discount bond. If the yield to maturity is lesser than the coupon rate, then the resulting present value will be greater than the par value and it will be called a premium bond. In this review, we are only interested in the accounting for a bond obligation. Other aspects of fixed income securities will be dealt with in the specific review. So face value, as we studied, is the maturity or par value. That will be the amount repaid at maturity. The coupon payments are the periodic payments calculated as the face value multiplied by the coupon rate. That is $5 in our example. And the yield to maturity at issuance is also known as the effective rate of interest. So this Y that we just studied, the discount rate that makes the present value of the cash flows equal to the price of the bond at issuance, is called the yield to maturity or the effective rate of interest. Please note that at issuance, the company or the borrower will receive this amount as a cash inflow from financing and will subsequently have to make coupon payments and principal repayment at maturity. The coupon payments are a cash outflow from operations, whereas the par value repayment at maturity will be a cash outflow from financing. We'll just see this in detail in a while. Now, we studied in the review of time value of money as well that the interest expense reported in the income statement for a period would always be the outstanding principal or the bond liability at the beginning of the period multiplied by the interest rate at issuance or the yield to maturity at issuance. So the coupon payment, that is the cash payment, may differ from the interest expense, as we will explain with an example. Correspondingly, the balance sheet liability of a bond is simply the present value of all remaining cash flows discounted back at the yield at issuance or the market rate of interest at issuance or the effective rate of interest at issuance. So let's understand the effective interest rate method with an example. On December 31st, 2010, a company issued a 3-year 15% annual coupon bond with a face value of $100,000. Calculate the book value of the bond at year-end 2010, 2011 and 2012, and the interest expenses for the 3 years, assuming the bond was issued at a market rate of interest of 15%, 12% and 17%. So I will do the accounting for the 12% bond. Please likewise do it for the 15% and 17% bond and verify your answers. So let's first depict the cash flows from the bond. It's a 3-year 15% annual coupon bond. So at the end of year 1, we would get a coupon of 15% of $100,000, that is $15,000. Likewise at the end of year 2. And at the end of year 3, we would not only get our $15,000 of coupon, but also the principal back. So it would be $15,000 plus $100,000. If the market rate of interest is 12%, then what will be the price of this bond or the amount that the company would receive at issuance? It will be the discounted back value of the cash flows. So we can use the TVM sheet to calculate the price of the bond. It's a 3-year bond, so N will be 3. 12% is the market rate of interest, so I by Y is 12. PV you can ignore, we want to calculate this. A recurring payment of $15,000 at the end of each period, and a principal repayment additionally of $100,000 at maturity. So we've given our 4 inputs. The 5th one will be calculated for us. Press compute PV. So the present value or the price of the bond comes out to be $107,205. So we'll store this in the memory register 1 in case we need it for the future. So this is the amount the company would receive at issuance. So immediately on issuing the bond, the cash on the balance sheet would go up by this amount, and correspondingly on the liability side, my long-term debt or debt would go up by the same extent. So this is the balance sheet as of year 0 or at the beginning. Let's see how these amounts would look at the end of year 1 and what will be the income statement impact of the bond. Please remember, the interest expense on the income statement is the outstanding liability multiplied by the rate at issuance. So at the end of year 1, the interest expense that the company will recognize would be the outstanding liability multiplied by 12%. We'd stored this value in the memory register 1, so we can recall 1 and multiply by 12%, giving us the interest expense for year 1 as $12,864. We'll store this in the memory register 2 and depict the interest expense as approximately 12865. Now, even though the recognized interest expense is only $13,000 approximately, we are actually paying $15,000 as cash. That is the coupon amount that we have agreed to pay every year. So you're recognizing an expense of $12,800 and you're repaying $15,000. The additional amount that you're paying over and above the required interest expense will contribute to reducing your liability. So the bond liability at the end of the year would be the original liability plus 12865 that has additionally accrued minus $15,000 that we have paid out. Or the liability at the end of the year can be calculated as the beginning liability plus the interest expense this period minus what we paid down, that is $15,000, as $105,070. Store this in the memory register 2. The interest expense for year 2 similarly would be the outstanding liability at the end of year 1 multiplied by the rate of interest at issuance as $105,070 into 12%, that is $12,608. Store this in the memory register 3. Now again, we are recognizing an interest expense of $12,608 approximately, but we are repaying $15,000 as a coupon cash outflow. So the liability at the end of year 2 will be calculated as the beginning liability plus the interest expense minus the amount repaid, that is $15,000 or 102678.5. Store it in the memory register 3. The interest expense in year 3 will be the outstanding liability multiplied by the rate at issuance, 12%, or an amount of 12321.4. And we'll use the same method to calculate the balance sheet liability at the end of year 3 as the beginning liability plus the interest due this year minus what you repaid, which comes out to be $100,000. So please note that the outstanding liability at the end of year 3 is nothing but $100,000, which is the par value that the company has agreed to repay at maturity. So even though we borrowed $107,000, we have agreed to repay at the end of year 3 the par value, that is $100,000. Hence, this liability must amortize down to a value of $100,000 at maturity, which is what is happening in the effective interest rate method as we just derived. Similarly, please verify that if you had done the calculation for the 17% bond, the value of the bond would have amortized up to a value of $100,000. It would have been issued at a discount to $100,000, and subsequently the liability would have kept on going up marginally to become $100,000 at the end of year 3. Please use the stow and recall functions of the calculator well, otherwise you'll waste too much time writing and inputting decimal points. You can also verify that the balance sheet liability at any point in time is simply the discounted back value of the remaining cash flows. So the value at the end of year 1 will be the discounted back value of the cash flows coming in year 2 and year 3. The value at the end of year 2 will be the discounted back value of the cash flow coming from year 3, so on and so forth. The discount rate would be the rate at issuance, that is 12%. We can verify our answers. For bonds issued at par, that is when the yield is equal to 15%, that is the coupon rate. The coupon cash outflow and the interest expense on the income statement will always be the same, that is $15,000. So there will be no increase or decrease in liability and no discount or premium to amortize. For the premium bond, we just did the calculations. And please verify yourself the calculation for the bond issued at 17% yield, that is a discount bond, will also amortize up to a value of $100,000 at maturity. Zero coupon bonds are bonds that do not pay any coupon during their life. They just pay the par value at maturity. So let's understand the accounting for zero coupon bonds. Two companies have identical value of $200,000 for cash sales less cash inputs and cash operating expenses. So this is like the cash flow from operations, that is of $200,000 for both companies. The only difference between the two companies is their financing. At the beginning of this year, PLC Incorporated sold $5 million face value of the zero coupon bonds maturing in 3 years. ALA Incorporated, that is the second company, sold $2 million of 15% coupon bonds maturing in 3 years. Assume the market rate of interest on these bonds at issuance is 15%. Calculate how much did PLC Incorporated receive for its bonds. So we're receiving $5 million at maturity and no coupon until maturity since it's a zero coupon bond. So the price at issuance can be calculated using the TVM sheet. It's a 3-year bond. The interest rate at issuance is given to be 15%. The PV needs to be calculated. There is no coupon payment during the life of the bond, as it's a zero coupon bond, and a face value of $5 million. So we can compute PV. So PLC Incorporated would receive about $3.287 million for issuing the zero coupon bond. So the interest expense in year 1 would be the outstanding liability. That will be $3.28 million multiplied by the rate at issuance, which can be calculated as approximately $500,000. Now please note that even though we will be recognizing an interest expense of $500,000 for PLC Incorporated in year 1, the actual cash outflow as coupon or interest is zero, since it's a zero coupon bond. So this entire interest expense would go on to increase the liability outstanding, and correspondingly the interest expense in later years. Please note that at maturity, that is at the end of year 3, this liability should become equal to $5 million. That is the amount that PLC will repay as the face value of the debt. So zero coupon bonds are also called discount bonds because they're issued at a big discount to their par value and they pay no coupons until maturity. Similarly, we can calculate the interest expense for year 2, year 3 using the effective interest rate method that we discussed. The last part of the question asks to calculate the cash flow from operations for PLC Incorporated and ALA Incorporated for year 1. Please remember that the cash outflow from operations is not this interest expense. The cash outflow from operations is equal to the actual cash coupon that is being paid periodically on the debt. Now for PLC Incorporated, there is no additional cash outflow on account of the debt or on account of the interest. Since it's a zero coupon bond, this entire interest expense will only go on to increase the liability. There will be no cash outflow. So the cash flow from operations in year 1 for PLC will simply be $200,000 that have been generated from the cash sales minus the cash expenses. For ALA Incorporated, on the other hand, the operating cash flows will get further reduced by $300,000. That is 15% into the par value of $2 million. So this is the cash coupon that ALA Incorporated is paying on its debt, resulting in a total cash flow from operations of minus $100,000. So this is something that the analyst should be careful about if they are treating interest expense as a cash outflow from operations, which is mandated in US GAAP, that companies can issue zero coupon debt to overstate their cash flow from operations. So both companies have taken significant debt. However, PLC Incorporated would make the entire repayment in one lump sum at maturity, which at that time would be represented as a cash outflow from financing, whereas ALA Incorporated is paying regular coupons and will repay a lower par value at maturity. So remember, the par value repayment at maturity is a cash outflow from financing, whereas the coupon payments periodically would be cash outflows from operations. Please verify your calculations for the interest expense on the bond on the 3 years. So the effective interest rate method of amortizing a discount or premium is mandated under IFRS. Under US GAAP also, generally it is used and preferred, but you can do the amortization using a straight line method also if the results are not materially different from the amortization that we've just described. So we can summarize the cash flow impact of issuing debt as the cash flow from financing will increase by the price of the bond or the present value of the bond at issuance. The subsequent coupon payments would be accounted for as a cash outflow from operations, and the repayment of face value or par value at maturity will again be taken as a cash outflow from financing. On the income statement, remember, the interest expense is always recognized as the market rate at issuance or the yield to maturity at issuance multiplied by the outstanding liability at the beginning of the year. On the balance sheet, the book value of the bond would be the present value of all outstanding payments discounted back at the market rate at issuance. So for premium bonds, this value would be the face value plus a slight premium. This premium would get amortized down such that the value of the bond would be equal to par value at maturity. For discount bonds, they will be carried at face value less some discount, and this discount again would be amortized up such that the book value at maturity would be equal to the par value or face value. Now, issuing a bond would often involve legal, accounting, printing, sales commissions, and other costs. In US GAAP, these costs are capitalized as an asset on the balance sheet and are subsequently depreciated over the term of the bond. So assume a bond with a par value of $2 million is issued for $1.95 million and there are additional issuance costs of $40,000. Then under US GAAP, these $40,000 will get capitalized, or the firm would increase assets to the tune of $1.95 million. Please note that the actual cash we have received is only $1.91 since $40,000 were taken away as issuance costs. But these $40,000 will still remain on the balance sheet as a deferred charge and would be expensed over the life of the bond. Liabilities correspondingly would increase by $1.95 million as long-term debt. So under IFRS, the initial bond liability will be reduced to the extent of the issuance costs. So instead of $1.95 million, we will always represent the liability as $1.91 million and a cash inflow of $1.91 million, effectively increasing the discount from the $2 million par value or increasing the effective interest rate. So there will be no capitalization and both cash as well as the liability will go up by $1.91 million. The cash inflow from financing would remain the same under both methods. So there's a cash of $1.91 million that we have received from the issuance of the bond. So bond issuance costs would be netted against the bond proceeds and reported as a cash inflow from financing. Now a bond is generally carried on the balance sheet at amortized cost. That is the cost using the effective interest rate method that we just studied based on the market yield at issuance. As the market yields change or the interest rates in the economy change, the fair value of the bond can diverge from the book value or this amortized cost. The fair value is defined as the economic liability at any point in time, or this is the amount of money that needs to be paid to buy back and extinguish all your debt today. Now both IFRS and US GAAP give firms the irrevocable option to report debt at fair value. If firms choose this option, then all increases in the bond liability will have to be represented as losses on the income statement, and all decreases in the bond liability will have to be represented as gains. These gains or losses would come because of the change in the market yield or interest rates and will have to be recorded on the income statement. For analysis, the market value of the debt may sometimes be more relevant than the book value, as this is the amount that needs to be paid today to extinguish the liability. So when bonds mature, no gain or loss will be recognized on the income statement by the issuer. The par value would be a cash outflow from financing. If bonds are redeemed before maturity, that is, the issuer buys back and extinguishes the liability before maturity, then a gain or loss may be recognized as the difference between the redemption price and the carrying value of the bond. So if the firm retires $2 million face amount of bonds for $2.1 million, when the carrying value of the bond liability is $1.95 million, the firm will have to recognize a loss since the firm actually paid $2.1 million for buying back a liability worth $1.95 on the balance sheet. If they had paid less, then they would have recognized a corresponding gain. This gain or loss is treated as a non-recurring item or a one-off and is not included in the cash flow from operations. The entire redemption price, that is $2.1 million, will be reported as a cash outflow from financing. In the case of US GAAP, if we have any remaining unamortized bond issuance costs, then these must also be immediately written off or included in the gain or loss calculation. Now, debt is normally issued with some covenants. These are restrictions imposed by the lender on the borrower to protect the lender's position. So theoretically, the company can borrow a lot of debt, pay everything out as dividends, and then declare bankruptcy. Or the borrower may otherwise mismanage the company such that repayment of the debt becomes difficult. So these covenants just try to ensure that the capability of the company to honor its obligations is intact and the lender's money is protected. So affirmative covenants require the borrower to do certain things. such as make timely payments of the principal and interest, maintain ratios like the debt equity interest coverage in accordance with the level specified. If the debt has been issued with some collateral, then that collateral should be preserved and kept in working condition. Similarly, negative covenants require the borrower to refrain from certain activities, such as giving out a lot of dividends or repurchasing shares, issuing more debt, engaging in mergers or acquisitions, while it still has debt outstanding from you. If any of these covenants is violated, the bondholders can demand immediate repayment of the principal, and this is referred to as technical default, the violation of any of these covenants. Details of these covenants will normally be found in financial statement footnotes. The footnotes can also disclose other qualitative aspects of the debt, that is the maturity dates, effective interest rates, any conversion privileges, covenants, assets that have been collateralized, and the amount maturing in each of the next few years. So that was about the accounting for bonds. We will study the accounting for leases and pension liabilities in the next review. Thank you so much. See you next time.